Good afternoon, everybody. Uneducated Economist here. Thought I'd talk a little bit more about the sovereign debt that's coming out of Russia. This is something that we have been talking quite a bit about over the last few days. And there is some serious issues that have come up, mainly with the repayment of these bonds and then the insurance policy that goes along with it. Now, if you're completely lost on the whole idea of what sovereign debt and the Russian bonds and the foreign holders of these assets and what's going on, I'm going to try and explain it pretty simply. Like I said, we've gone over this quite a bit over the last few videos, but I think that if you really want to try and understand what it is that is taking place out there, you really have to follow what's taking place with the sovereign debt market, because this is really where the countries of the world, this is when they start going into issues as far as the pain, the economic pain that people will feel within those nations. So now, Russia. Let's just talk about Russia for just a second. They sell their debt, they sell bonds, they borrow money. This is all the same thing, and what they do is they sell these bonds to anybody who's willing to pay for them. Now, these bonds, typically, you're going to find the institutional investors within that nation are going to be the major buyers of them. That's going to be the insurance companies, the retirement funds, whatever it is that's going on within that nation. Typically, they are going to be the major buyers of the debt, of the Russian debt. But they're not going to be the only ones. There's going to be a lot of people who will want to buy into this debt. And so foreign holders of these bonds, they're in a position in which that the Russian central banks and the government was just basically saying, I'm sorry guys, but if you're a foreign holder of these bonds, we're in a situation right now that unfortunately we're not going to pay you. Now, if you are a holder of this debt, this is a bad deal. You're like, well, I just went and lent all this money to you. I'm anticipating a return. I have this bond that is now becoming worth less and less every day as the idea of getting paid back on it diminishes. So now it has a price tag to it. It's not like it's just going to be worth the same amount every day. The price moves up and down. And as the price goes down, the yields rise. So now if you are looking at a place where you're trying to find yield, you find it in risky assets, something similar to this. But then you can get into an asset that is so risky that it defaults and then you don't get paid. So this is the reason why the yields rise and the prices fall, is because the investors don't want to buy it anymore. And if they were to buy it, the yield that it would pay would be so much that it's obviously it's moved to a point in which that it's probably more likely going to default. So that you have an insurance policy that will pay you in case it does default. Those are called credit default swaps. So an investor who lends money to the Russian government in exchange with the bond, the Russian government says, I'm sorry, you're not going to get paid, but that's okay because you have an insurance policy that will kick in and make you whole again if the Russians fail to make the payment on the bond. However, the issuer of the credit default swap looked over and said, now wait a minute here, this isn't exactly like a technical default. This is more out of the scope of our obligations, meaning that because they're choosing not to pay and not really just can't pay, this isn't exactly like the default that we would pay out our insurance policy on. So unfortunately, you're not going to get your money for the insurance policy either. So now this is where it really starts to get critical, because how do you know how worthy an investment really is? You're looking over there at those bonds and you're like, yeah, they dumped out pretty good, but man, that might not be a bad idea to get into this. I mean, they're really cheap, they have a really high yield, and if they do happen to not fail, well, then that's going to be a pretty good deal if they come back. How do you know? What do you look at to say, is this going to be worthy or not? Well, go and look at the credit default swaps. Go and look how much the insurance policy to cover that particular investment is. And if the insurance policy is fairly low, even though it seems or appears to be risky, most likely the credit default swap issuer recognizes that it's not as risky as it appears, and therefore the premium would be much lower. But if the premium is really high, like if you have to pay a huge insurance premium in order to protect your investment, well, that's the issuer saying, I'm not really comfortable with you holding this position and us insuring that because the chances of it defaulting are really high. Well, take a look at the article that I have down in the description right now for the credit default swap issuers of the sovereign debt coming from Russia, and they are asking for an extreme amount of it. They're asking for an extreme amount of the down in order to buy that insurance policy. If I got it right, it was something like $10 million worth of bonds needs $5.8 million down to insure it. I mean, you pretty much have to put up all the money to cover it. It's basically saying there's going to be like a major chance of default. It's ultimately saying like we anticipate that that will definitely default. Otherwise, we wouldn't be charging as high of a premium on it. But we're pretty sure of that. So this is where it really starts to get interesting, because this is the shadow banking system. Remember, these credit default swaps, this is the derivatives market. This is the one that could have a dominoing effect throughout the entire economy, far beyond what anybody had ever anticipated, because really it's an unregulated market. It's not noticed on the radar of like the central banks and their data keeping, because it's not really part of the central banking system. It's part of a private banking system. And this is really where I think a lot of people get confused on, what it is that the central banks of the world are meant to do. Because like I said, you have a private banking system and then you have like the central banking system. And when it comes to this private banking system in the derivatives market, they can insure just about anything out there, but they don't necessarily have to tell people that it's insured or how much insurance there is out there on it. So this is where it gets really kind of into that dominoing effect, is that once these credit defaults begin to kick in and start paying out, nobody knows how big the payouts are going to be and how much that will start to drag down the rest of the industries out there. And just to kind of give you an example of how this might look, I thought it might have occurred somewhat in the Evergrande and the property developers coming out of China. As these guys started to go into default, or the idea of them going into default and kicking in the credit default swaps, the insurance policies that are covering these things. Because ultimately what you have to think about is that who is it that is holding the debt? Like with Evergrande, they had a lot of contractors that work for them. I mean, Evergrande's a major property developer, so they're building buildings and they're hiring people to do that work. So as they're building these buildings and they're hiring these people to do the work, the contractors, they're paying them in something called commercial paper. And now commercial paper is something kind of like a bond, in the sense that it has a face value and it's going to come due in a certain amount of time. Generally, it's less than a year. It's like a short-term debt obligation. But ultimately, these commercial papers, they will have like a face value for it. And for example, it'll be like, say, $100 on the face value. When the contractor receives this commercial paper, they'll receive it at like $98. Right? So they get paid, if they were owed $98, they get paid in this commercial paper. And if they hold on to it for a year, they can get paid $100. So it's a way to like make a little bit of money off of the payment that you get from pretty much the contract that you had completed. But it also postpones the person who paid you a little bit of time. So they get a little bit of time before they actually have to make the payment on it. And for waiting to actually get paid, you get a little bit of interest for it. So this commercial paper is a very common tool to, settle payments or just do commerce in general with your contracts. I mean, this is a very common piece of contract. Well, here's the problem. If Evergrande fails before you get paid out on that, well, then that commercial paper begins to lose value. You may not get your $100 or 100% of face value. You may not even get the 98 cents or whatever you got on the dollar from when you first received it. It may go below that. You may only get 50 cents on the dollar or even less. So if you are a company that had been working for Evergrande and now you have this commercial paper on your balance sheet, and it's beginning to lose value, well, now your balance sheet is becoming offset, right? You have assets and liabilities just like everybody else, and the asset that you have is now losing value. Your liabilities are now higher than your assets. Your credit rating begins to fall, making it ever more difficult for you to borrow money. And so on down the line this goes. So if you can imagine that as these commercial papers, these bonds, all the things that are out there that are guaranteed to pay begin to lose value, or begin to drop in what they are originally going to pay, those are technically defaults. And if these things begin to default or lose value like that, generally that's going to kick in the credit default swaps, the insurance policies. Now we start having the ball rolling and get bigger and bigger because we don't know how much of those credit default swaps are actually out there covering this stuff. And this is where we found, like back during the great financial crisis, that the shadow banking system and the credit default swaps that were issued into covering those loans was far more than what anybody was anticipating. And when the mortgage market began to turn and those credit default swaps began to kick in, those insurance companies simply couldn't afford to make the payments on it. And then you had things like AIG beginning to fail, and if these guys failed, then it starts dragging the whole system down. So it was a very systemic problem. Anyway, these are the things that we have to look at, and I think what's going on in Russia right now is a very good case study on what it is that other nations are going to do when they begin to get into trouble. You know, you were promised to pay, you bought an insurance policy to pay it, and it's still, you're not going to get it. You still don't get yours. So anyway, interesting times. I know this is kind of like the same stuff that we're kind of been going over, but I thought it was important information to talk about on how those credit default swaps, the price of them have moved up so dramatically high that they're obviously pointing at a default in the future. Like, they are very concerned about it. And then also, thank you very much for everybody who has contributed to Jordan's GoFundMe page. Like I said, we're getting very close now. She is, I believe, within $1,600 of reaching her goal on the GoFundMe. So I very much appreciate everybody who has sent just even a few dollars, even if it's $5 or $10, if you could help out in any way you can. Jordan's in a very tight spot. She just recently had her 3 nephews kind of dropped into her lap. Her sister, the kid's father, they are nowhere to be found. They are not helping at all. She is very overwhelmed with this whole thing, and she's doing her best. She is very brave to take on such a challenge. So I appreciate any support that you can give her. She can use it right now. So thank you very much, guys. Uneducated Economist, you let me know. You can find the link to her GoFundMe page down in the description. All right, you guys let me know.